Emergency funds are for emergencies, right? It's not because some special brand name apparel was on sale. Doesn't mean you can't buy it, but that's not what the emergency fund is for. Emergency fund is for unexpected expenses. So let's just say you're working, you're trying to buy a home. You want to know, what are your basic living expenses?
Hi, welcome to the Posner Property Perspective. Today we have Ray here from Southeast Wealth Partners. He's a CFP, as well as he's got a master's in business administration, and not just limited to the Southeast. We just talked for a second. You really can go all over. You can guide your clients for their financial future. And a big piece of everyone's portfolio is their home. And how does that entrepreneur, that business owner, get prepared to buy a home? What does they have to do?
Right. Well, I think, with financial planning, a lot of times we think about goals, and owning a home is certainly a very big goal and a very important one. As we've seen the last 5 years or more, those folks that already own a home, most of those folks have been pretty happy that they own a home, right? They've been able to live in it. They've had mortgage rates or lower, but they're still reasonable historically speaking. So from a financial planning perspective, if you don't own a home yet, you gotta have a plan, right? Plan for, well, how much money do I need to bring to a closing table to make, to be able to do it? And so oftentimes that's going to be leaning into your relationship with realtors, mortgage people, which is, hey, how much down? Because I grew up in a realtor household, and I think a lot of people don't know, right? They think, oh, is it 20%? Is that what I put down? Right. And of course there's, programs you don't have to do that much down.
Right. You can put anywhere from 3% to 20%. So 30%, it all depends.
Yeah.
So there's a lot of opportunity. And one of the things is, how do you prepare to start saving it? Like, where do you look in your budget when you're helping someone plan and they need to plan to buy a home, or maybe they want to help their son and daughter who just got married buy a home? How do you talk to them about how they put that together?
Right. So let's say someone's thinking or planning a little bit ahead. They're like, hey, I'd love to be in a house like in 3 months, but maybe financially they can't quite pull it off, but maybe they could pull it off in 12 months. And how much do they need to save or corral, if you will, some money for that down payment, and then start to look and see, well, what are those payments going to look like? Factor in all the factors, with a mortgage. And I think 30-year mortgages is still pretty popular. And the thing that, especially for the younger folks that may not kind of realize is, say $1,000 today or $2,000 today, that, that's not going to feel the same way as it will in 15 years. Whether inflation is 2%, 3%, or whatever it is, it's going to be a little easier, or it should be, right? It's going to feel way more affordable down the road. And so, it's kind of important just to conceptually understand, like, oh, that's nice. Like, now my income's a little more, and as things that inflate, you start to see maybe your 401k, things like that, appreciate in value. You feel like, hey, that mortgage that felt a little bit tough at the beginning is hopefully not so tough down the road.
And you just mentioned 401k. So a lot of home buyers are going in later. They're a little bit older when they're buying their first home. So maybe they have some nice amount of funds in that 401k. How can they use a 401k to then purchase a home?
Right. Good question. So with a 401k plan, whether it's in your employer's plan or maybe you're a business owner, generally speaking, you could, assuming there's a loan provision in the 401k plan, you could loan up to half of that account value up to a maximum of $50,000. So let's just say somebody had $110,000 in their 401k. They felt like they wanted to borrow $50,000 from it, would be able to do that. And then they pay it back over time to avoid a prepayment penalty or to avoid it being income so that it's taxed, right? So you do have to pay it back, but you could take a loan out like that. And most plans will let you pay it back over a 5-year plan. I had a couple business owners that have been able to use a 30-year payback on that. So yeah, that is certainly an option for some people.
It, you mentioned business owners, because that's one of the things. Being a realtor, we run our own business. And so, and if you own a business, if you own a boutique or a restaurant, a lot of times as an owner, you're striving to write off as much as you can for taxes. But there's a
Right.
problem with that, because then you don't show that income. So
Right.
how do you help advise small business owners, solo entrepreneurs to start saving so that they can purchase a home?
Yeah. So for the business owners, that's always the challenge, right? Is how much can I reduce my tax bill this year, right? That seems to be a very common theme. And there's always two sides of every coin. So for a business owner, you're really looking to buy a home, you're probably going to need to show some income on paper
Income.
to qualify, right? Or some kind of assets to qualify. So it's important to kind of figure that out. So for business owners that are out there, a lot of times if they're looking to reduce a tax bill, it's possible maybe you're putting money into a 401k or a defined benefit plan, possibly, or lots of things out there, right? Cash balance plan, things like that. And depending on the lender you're talking to, because money's going in there as an option, you might be able to qualify for a loan if you were to do less into those plans. So sometimes writing off everything you possibly can right before buying a home may kind of go against you when you're trying to get that loan for a home.
So that goes back to that planning and what your goals are. So when you sit down with a client, I'm assuming you're going up with what are your goals for maybe the next 3 years, next 5 years, 10 years? How do you break it down with your clients?
Right. So we always taking a snapshot, which is like, where are you right now today? What are the assets? What are your liabilities? What's the cash flow? And then take a peek at, well, what is the next 12 months? What do you think it looks like? And that way, because if you already have a home, let's talk about that, right? If you already own a home, maybe already a little bit ahead of the game, which is, okay, I got a home, I have some equity, I want to buy the next home. And so your first question, so one of the questions would be, well, what do you want to do with your existing home? Right. And so sometimes homeowners will say, well, I want to take all the profits out of that house and buy the next home because I don't want to pay taxes. That's not exactly how it works anymore. In that scenario, if you're a married filed joint return, you can appreciate up to $500,000 of capital gains tax free, whether you put it all into the next house, whether you took a couple months off, it doesn't matter. So it's really important to know what do you got to work with, because sometimes people don't know. And so let's just say that this particular couple moves into the next home. Well, instead of putting it all down as a down payment, the equity of the home, maybe you're buying an ugly duckling. They had a realtor, that did a good job for them finding an ugly duckling, just need a little bit of work. Right now, they can take some of that cash instead of putting it down as a down payment. Maybe a portion of it gets earmarked to fix up that house and make it, be a lot more enjoyable to live in. So we kind of got to see where the person is starting from. So if somebody already owns a home, that's one idea. If somebody doesn't own a home right now, we just got to figure out, are they eligible for a VA benefit? Don't need to put any money down. That's different, right? Versus someone that needs to save it. Now, certainly money that's saved for down payment should be money that is put into a nice, safe place. Maybe it's getting some interest, but that principal should be protected. If you're trying to put money down on a house, I personally wouldn't be putting it into stocks or something you're trying to use in the next 12 months. Some people do that. I would probably not do that. I would probably put it in something that's principal protected.
Do you ever advise younger people who are buying homes on things like having an emergency fund? Where should you have certain funds? Because when you buy a home, things happen.
They,
Paperwork.
exactly. No, that's a very good point. It's funny we're talking today. Actually, I got pulled into a local high school nearby, and I was talking to some high schoolers about financial planning. So it's kind of like
Yeah.
a pro bono thing, but it was fun. And we talked about this. We talked about emergency fund. and it was very interactive. And one of them was like, "You need $1,000 in emergency fund." I'm like, "Hey, that is a really good starting point, especially for somebody young, right?" So emergency funds are very important. Emergency funds are for emergencies, right? It's not because some special brand name apparel was on sale. Doesn't mean you can't buy it, but that's not what the emergency fund is for. Emergency fund is for unexpected expenses. So let's just say you're working, you're trying to buy a home. You want to know, what are your basic living expenses? What is that number? Is it $2,000 a month? Is it $3,000? Whatever that number is, you would want to have 3 to 6 months worth of those expenses in an emergency fund that is not susceptible to dropping in principal value. You want that to be nice and safe. Maybe you're earning some interest. That would be great. So once you get to that, you check that box off. Now we can talk about what are some other investments. It doesn't necessarily mean if you're working for an employer and they're giving you a 401k match. Yeah, absolutely. You could be putting money into the plan, at least getting the match for the employer, the quote free money. And you could do that in conjunction with building up the emergency fund. You don't have to get $30,000 in emergency fund before you put money in a 401k, right? You could do those kind of simultaneously. So we try to get things down on a paper so that, or really today it's not paper, right? It's into a financial planning software system so that people can actually see, okay, where am I putting my money? Because you absolutely should be paying yourself first, right? So prioritize, what are you trying to do? Are you trying to buy a second home or rental home, right? That's another goal. So we got to earmark some money for that.
You just mentioned rental homes because one of the things I've talked to several of my clients with is they have those 3% interest rates and they don't want to give that up. And they're looking to buy a new home and they have the money to put down on the new home without selling their old home. So turning that sometimes into a rental property becomes a good asset to add to their portfolio.
Right. So, it's funny. When I was much younger, I bought my first home, 23, and I bought it for $123,000,
You did good.
which is, you can't get a house like that anymore. But what I did in that particular scenario, again, I know we're not giving advice, right? We're just talking in general here. But in that case, what happened was I had just got married. We bought a house. And back then we got I think it was 0% down. I don't remember, maybe 5% down. And we bought a house and we rented out the house. Now in our scenario, what we did is we rented it out only for 2 years and then sold it. And we got that capital gain tax free because it was our primary home and we had lived there 2 of the previous 5 years. And then we did the same thing again when we sold that house, like, I don't remember anymore, 3 years later. Again, that's not what everybody should do. I think we just kind of lucked into that. But like to your point, if you have a mortgage right now that's 3%, some people might think of that as an asset. I mean, technically speaking, it's not, but it's going to feel like it. And yes, maybe you're renting out your house, you're getting that income coming in, obviously get with your accountant, your CPA on the tax, hopefully some tax benefits on it. But the nice thing about those fixed mortgage in that scenario is, let's say you've been in that house for 15 years, perhaps. Every time you make that new mortgage payment on that 3%, it's eating into the principal. And so now you're able to eat into that principal a lot faster. And you're just building that equity even faster for when you do sell, which kind of brings us to the next thing is, well, what do you do when you sell a rental property, right? You've got some choices. One would be, you may pay a capital gains tax, but sometimes that's not that much. And if you time it right, you may pay very little in capital gains. And if you made a lot of money, a little bit in capital gains, maybe that's not a big deal. Or if you want to defer the tax, you could do a 1031 exchange. So,
do you do 1031 exchanges with your clients?
I give advice around planning around 1031 exchange. What we do, I'm not a licensed realtor. I've done real estate in the past. We know realtors sometimes, right? And for some people, doing a 1031 exchange is what they need. And I know the process. So I help give advice around, make sure you got a qualified intermediary at closing table. This is not a do a
Right.
closing and then, oh, I want to do it, a couple months later. You want to do that. The only thing I will say that we're involved in is sometimes people do a 1031 exchange and maybe they don't do, let's say they made I don't know, a $500,000 profit, right? And the next place, maybe they got a real good deal on a slightly less property. So they had $400,000 going into the next property and they had $100,000 that didn't go to the next property. Maybe they don't want to pay a tax on that. So we can put that into a deferred sales trust. I call that, let's put the crumbs over there just to kind of defer all the tax and maybe any kind of depreciation recalculation. So we do some of that, but that's really to the extent of our involvement with 1031s.
I'll probably have to do a whole podcast on 1031s, but just so real briefly, the seller never touches the money. So we'll have another podcast on 1031s, but just know that if you ever do one, if you somehow the money goes into the seller's account, it's not going to be a 1031. So
very good point. Yeah, you could do a whole podcast on that.
I think that'll be, I just came up with the next one. Now that they've gone on and they've purchased their home and maybe you've helped them develop their budget, what kind of other goals do you help them set, especially maybe if their long-term strategies? What kind of things do you help them discuss, move along with?
One of the things that most people have to deal with is retirement planning. For most people, you can't just wake up and you're good to go for retirement. It's something that takes some being intentional, right? Putting money away so that it's working for you. That was one of the things that came up today. I kind of did a demonstration of compound interest for those high schoolers. So anyway, it's really, well, how much do I need to save? That's really, at the end of the day, that's a big piece of it, right? It's so easy for us to want to live for today, but sometimes that's the expense of our future selves. And then you can have the opposite also be true, right? You might have someone that is only living for tomorrow and doesn't enjoy today that much. They're always thinking about tomorrow. So really, by having a plan where we start to be process driven, we have an emergency fund check, we're putting enough money into a retirement money check. We're putting enough money into another bucket. I like having diversification. It gives you greater flexibility for when a problem happens in the future, or maybe even an opportunity, right? So think about, go back in time, 2008, 2009, 10, 11, 12, right? If you had money you could deploy in the real estate, or even stocks going back to 08, 09, that would have been a really good position to be in, to be able to deploy some capital at some of those assets. So anyways, we're just, and then when somebody gets close to retirement, you get really close to retirement, 5 years or less, that, in my opinion, you really got to sit down and go over it. I would say pay somebody a fee to go over it that's a CFP, or if you have an advisor already and they got some real good skills around financial planning and maybe you're paying them a fee in some way, really want to sit down and you don't want to get it wrong when you're 5 years or less for retirement. You can get away with some mistakes at 30, but when you're in your 60s, that gets a little more painful.
Well, you just brought up something very important. So I think a lot of people don't understand what CFPs are and how it pays to pay them versus going to some of these other institutions where they're getting commissions on what they're selling. And sometimes they may do what's best for them and not what's best for their client. So explain how, like a CFP, how that works.
Right. That's a good question. So a CFP, certified financial planner, professional like me, has to go through a bunch of courses in a lot of areas, whether it's estate planning, asset allocation, insurance. You kind of it's a very well-rounded, robust program. I don't know of anybody that's able to study for that in a month and get one, right? It takes time. I chose to do it at night, online studying, because I had a full-time job building this business up. So that's how I do it. And at the end of that, you have to pass an exam to be able to get that certification. And then when you do get it, you can't just forget about it and keep the designation. You got to take continuing education to be able to keep the designation. And there is a very high ethical standard that you got to adhere to so that we're taking our fiduciary roles with folks. We're trying to get into their shoes to be able to give advice. Now, I will say the word fiduciary to me, is over marketed, misused oftentimes. But here's how I would like to say it, and how I kind of implement it into planning is, let's find out, where is somebody at? What are they trying to accomplish? What are their goals? Get to know them as far as, yes, numbers and statements, right? Where are they at? But also, where are they at just from a behavioral past? Because that also is important, right? Did somebody have a really good, quote, lucky investment experience? Did somebody have a real bad taste in their mouth, right? Did somebody have good examples or bad examples? So getting to know those things are really important too when giving advice on what to do. So what we try to do is have a plan for everyone. And then in the plan, there are some solutions. And oftentimes there's not you got to do it this my way or the highway, right? Oftentimes I might be, hey, here's a recommendation that I think is best for this particular part of your plan. Here's another kind of a B plus recommendation, still good. It's better than where you're at now, but maybe not as good as I think the A plus might be. But we want to, as a fiduciary, we'll be very transparent. To me, transparency is the most important thing. So for example, who knows, you went to a dinner and they told you how great a product is. It doesn't mean that product is bad. It just means, is it appropriate for you in your situation? So it's really important that if it's an investment, a product, or whatever, you want to know, well, how much is this going to cost, right? You need to know that. And how does the person that's making the recommendation, how are they getting compensated? You want there to be transparency there, because you have choices. You could pay for a plan only, or you could pay. There's many ways to kind of compensate somebody for their time and their expertise.
It's interesting you said that, because there was the lawsuit this year against real estate agents, realtors, and we have to be Georgia was one of the better states. We were pretty transparent with the fees, I will say that. But it's now very important, very up front, that people understand realtors are getting paid for their time and their expertise. And how does that work? So it's the same kind of things there, I think, with certified financial planners. So that's important. Again, it even comes back to budget, because you have to budget in for the fee and see how it all plans out.
Right.
It's important to have someone on your team of all your different professionals. You're going to have attorneys, realtors, accountants, financial planners, to really help put that whole financial package together and help direct you to your goals. And that's one of the things we've talked about a little bit today, is planning your goals and having a budget. I had the honor of hearing Doug Dunford, he just retired as the chief economist of Fannie Mae. And he was talking, he said he had a new employee come in, and she'd been with the company, with the government for like 6 months in his office. And she was asking for a raise. And he was laughing because he said, and this is nothing against Starbucks, but he noticed every day she came to work with a Starbucks. And he said to her one day, how much does that cup of coffee, cost you every day? He said like $7. And he's like, you know what? And do you get it on the weekends too, besides the 5 days? And he's like, yeah. Take that $7, multiply it by 365. I'm going to give you a raise for that amount, because I'm going to tell you to start having your coffee at home. But it all gets down to budgeting. Like, if you're going to budget to purchase a home, you are going to have to make sacrifices. And what are you willing? And so if you sit down with your financial planner and you say, you know what, I need to be able to get $30,000 so I can buy a home. Right. You're going to sit down, but you are going to have to make sacrifices. You're going to have to choose where your funds are going to go. And you may have to not go out as much, or maybe not go on as many vacations. You're going to have to change things, but it gets back down to budgeting.
No, you said a couple things there. One was we're going to get to what's called a 50-30-20 from a budget standpoint, but you mentioned about the realtor situation. So let's just say you're buying a home and, you're working with a realtor, right? So yeah, the realtor, there's a transparent commission there, but it's all about value. So that's why you want to select the right realtor for you. And hopefully that realtor, they're not just opening doors, they're your advocate, right? And I know there's a difference between realtor and a licensed real estate agent, right? I understand there's a difference there, but that realtor, hopefully that's opening doors, giving advice, is truly working for you and getting a good deal on the house for you. But not only that, they have a network, like you mentioned. Who knows? There could be, from a financing standpoint of the property, but what about all the contractor relationships that realtor has? Hopefully they've built a good network of contractors and contacts. So especially if you're new to the area, right? You're going to be really happy. Hopefully that realtor is you can access them and they're going to help not just give you a contractor's name, but make sure that contractor calls you and does a good job, because if that contractor doesn't do that, they're probably going off that realtor's list. So that was on my mind. But then going back to the budgeting, right? So there's lots of different ways out there. One of them is called a 50-30-20, and all that is maybe about half of your check is going towards, or half of your income is going towards your basic needs, right? Your eating, your housing, your transportation, utilities, health insurance. And then maybe you got about 20% be going towards really savings, investing, right? Doesn't all go into 401k necessarily, but a portion is, and maybe you're getting some employer match, but you should have, that's kind of a round number. Again, it's not a recommendation, but it's a strategy that some people implement. And then you got 30%. And if you pay yourself first in those ways, right? You got to pay the mortgage, right? You don't want to not pay the mortgage. You want to pay the credit cards off, dude. Pay those credit cards off.
Yeah. That's, you know what? That's an instant saving of like 23% to people.
Yes. Yeah, absolutely. And so then you got this other 30%. That's the fun stuff. That's what we want to do. We want to go out to eat. We want to travel. We got our hobbies, our subscriptions, and all the fun stuff. But if you pay yourself first in those other buckets, then there really should be no guilt on spending the rest of the money, because you have paid yourself first. You're on track for retirement or any other goal that's before that. Maybe you're thinking of college funding for a kid, or you're thinking of a second home, investment property, whatever it might be. And then, yep, I'm paying my mortgage, got my food, all that fun stuff. So I kind of like that. That's not a bad recipe for someone to explore with, from a budgeting, or a better term would be a spending plan each month. Yeah.
So as we're summing up, is there any last minute thoughts of something you want to share with the audience?
Yeah, I think so. If you're a business owner, you probably, and if you're a realtor, you're a business owner, right? Whether you're whether you're working in the business or on the business or somewhere in between, you're a business owner. And if you have obviously employees, you're also a business owner. So that's its own planning, right? That needs to have its own dedicated planning discussions, but that is part of an overall personal planning kind of conversation. So that's something to keep in mind. And then if you're, not a business owner and you got goals around real estate, an important asset class in, the majority of people's plans, no doubt about it. And so my kind of call, if you will, is to try to be proactive in the planning and really get a sense of, am I on track? And don't just, some things you set and forget, but other things you also do want to monitor what's going on. And you want to be, if you're doing it on your own, you can absolutely do stuff on your own. Some people can do that. Some people don't want to do it. Some people really maybe shouldn't do it on their own, but a lot of people can, especially at a younger age. But you don't want to not monitor it and measure it. Like, well, how am I doing? Right. And, you got to be kind of, have that look in the mirror moment. Am I too cash heavy and I'm not making enough growth out of my account, or am I wildly speculative and I'm taking on risk? Maybe I'm okay at the moment. So it's really important, I think, to have probably somebody with experience, whether you're working with them or not, but have somebody with experience. If you're doing it on your own, just take a look and make sure that, you're going to be okay moving forward, versus just kind of having rose colored glasses and like, hey, I've been doing great. Well, over what time period? Was that a 12-month period? That could happen. Right. So that's what I would say.
I think that's good advice, that you always want to review your plans and you want a certified financial planner to look at them, because what you need when you're 25, 35, 65 is very different. And even as you get into 80s, I just saw in one of my groups, we just celebrated someone's 103rd birthday.
Wow.
And most people didn't make plans to live to 103. I'm thinking, wow, that sounds great. But I'm like, ooh, that's a little scary too. Like, are we set up to live that long? Are you going to outlive your money? So it's important to constantly be evaluating it. And what may have worked good in 2020 may be very different than what's going to be 2025. So it's important to I think communication, like you said, communication and budgeting is an important feature. Ray, I want to thank you for coming on today. I'm so glad that you went out to the high schools and you talked to them about budgets, because when they got rid of home ec and all that, they don't teach the basics.
Yeah, you're right.
And it's really a shame that a lot of our kids don't understand financial planning. And if you start early, I think they say, like, if you put $100 away each month when you're 25, when you start at 25, you can have more than $1 million when you're 65.
Right.
So,
yeah. Start early. No doubt. No doubt.
So again, thank you. We'll have Ray's information down below, and we look forward to seeing you at the closing table. Thank you.
Thanks for tuning into the Posner Property Perspective. I hope you enjoyed today's episode and found it helpful as you navigate your real estate journey. Remember, whether you're buying, selling, or just exploring the market, I'm here to help to make the process smooth, exciting, and stress-free. Let's take the next step together. Contact me today. I'd love to hear from you and make your real estate wishes come true.